Welcome to Amberger Smackdown at todaysfinancialnews.com. I'm Christoph Amberger. What a difference a year makes. 12 months ago, the art and science of doomsday forecasting was the exclusive domain of newsletter editors who, out of long-standing habit, consider bullishness on mining companies and disdain for stocks the perfect expression for being a contrarian. Today, everyone's a doomsday prophet and everyone's a contrarian, even though few may remember what that actually means. You see, contrarian investors think of themselves as diametrically opposed to trend investors. Instead of following a trend, be it in its beginning phase or further along, they invest in out-of-favor assets in the hope of striking it rich if and when that respective asset begins to regain favor. Being a true contrarian requires a bit more risk tolerance and residual life expectancy than trend investing. After all, in normal market environments, upward trends typically affect a limited number of assets at any given time, while stagnation or even downward trends are liberally spread across the rest of the market. And you can always lose another 90% of your principal investment. Add in that some market trends can take decades to work their magic. It took gold 30 years to get back near its historic highs, and even then only if you skip adjusting prices for inflation, let alone opportunity cost. Profits really only materialized for those investors who jumped on the bandwagon back in 2001 or 2, when gold started to move up after years and years of sideways crawl. In short, for trend investors. If you look at today's volatile equity markets, it's quite difficult to say if we're still in a phase of correction during an extended upward trend, or actually at a point of trend reversal. The difficulty arises in part from the fact that over the past 15 years we have seen a dramatic increase in the equitization of assets. Those assets include natural resources and energy, as well as collateralized debt and real estate. Just consider this. Up until the end of the last protracted medium-term bull market in 2000, equity markets and real estate by and large moved as distinct asset classes. In fact, part of the lengthy slump in the US stock markets after 2001 was caused by diverting money people would have invested in stock investments and speculation into real estate, depriving the stock markets of fresh capital. Gains in property speculation and new developments spawned a secondary boom in the industries that profited from it and eventually helped lift the stock market indexes. Home builders, banks, mortgage lenders, and last not least communities saw revenues increase and stocks appreciate. So did retailers and manufacturers of home furnishings and appliances, and those who procured the machines and resources for those secondary booms. It should be pointed out that back in 2000 or 2001, there were few indications that in an era of modest inflation, mortgage debt would regain its attractiveness as a wealth-building tool. After all, since the savings and loans debacle in the early 1990s, US real estate had enjoyed few genuine upswings. Those who decided to put their money into real estate were true contrarian investors back then. So were those who decided to keep investing in equity throughout 2001 and 2002, when investors looked at stocks like they would at free tickets to a Madonna movie. Those who allowed cash and recession to dollar-cost average their new stock investments saw their money double and triple depending on what market they were in. The post-2001 real estate boom reversed trend in 2005, as is shown in the stock price charts of home builders and mortgage lenders. Lacking an efficient clearinghouse, actual prices of real estate sold still don't reflect the full extent of the decline, but the equitization of its components over the past year was sufficient to short-circuit equity markets, not just in the United States, but all over the world. So where is a contrarian to put his money now? I doubt that it involves resources or precious metals, whose sustained upward trend over the last few years is due as much to speculation as it is due to the US-led and debt-fed consumption boom. But looking at beaten-down mortgage lenders, online brokers, and home builders, I couldn't help but notice valuation jumps of 50 to 70% in the last few weeks. I asked my colleague Brian Bottarelli to develop a solid option speculation for you that I introduced in the last Smart Trading Action Alert. A play that allows you to potentially make substantial gains, but also be, at least for a while, a true contrarian investor. Please follow the link we include with this video for the full report. For For today's financialnews.com, I'm J. Christoph Amberger.
Prices could realistically get as high as $73 or $74 a barrel this summer.